Hello all, this is chapter 8 for corporate finance, cost of capital. So make sure you watch this video and the following ones very carefully. It basically serves as our lecture that I had planned for this week. Okay, so the learning objectives for this chapter are understanding the concept of cost of capital, understand the major determinants and components of the cost of capital, identify the differences between operating and financial leverage that both are going to have important implications for cost of capital, and then an easy and simple way to calculate cost of capital for capital budgeting projects. Okay, so as usual, I'm gonna skip the chapter outline here. So again, we're gonna have different principles applied here. For example, we have risk-return trade-off as usual. So when you think about a capital budgeting project, you're basically thinking of an investment, right? You want to decide whether to do or not to do an investment, and that's going to basically say, well, what's the return, what's the risk? So risk-return trade-off is going to always be there. We're going to have time value of money as well. So why do we care about cost of capital? We're going to see cost of capital as the opportunity cost of putting our money in a particular investment project. That means that we are viewing this as an investment that is going to generate cash flow in the future or revenues in the future. So we would only take this investment if the present value of the revenues or cash flows exceeds the present value of the cost, that sort of thing. All right. There are other principles that we use, but these two are the most heavily used ones. So I'm going to skip the rest and move on to the actual material. So let's first agree that the cost of capital in a capital budgeting project is the required rate of return. It's the opportunity cost of investing whatever fund you want to invest in a project. What is that opportunity cost? In essence, you want to think from a perspective of an outside investor. You're the manager, you come up with an idea, you put together a project. What would the market charge you if someone out there would be willing to give you money so that you put it in this project? So it's again about some sort of consensus within the market about the risk and return trade-off within the project. So see that risk-return trade-off principle is actually here. The important thing is that decision is being made today. So the cost of capital that we're talking about is what investors perceive as the opportunity cost of that particular project today, not in the future. All right, and it should obviously reflect the risk of the project as well. This basically tells us the cost of capital is not the historical cost of funds. So you do not look at the accounting figures of a particular firm to find out what the cost of capital for existing projects or the future projects could be. You would actually have to look at the perspectives of the particular project and the risk within the firm, so on and so forth. And then that's going to help you get to the notion of cost of capital. So in order to get what cost of capital is, let's just start as corporate valuation. What's the value of a firm? The value of the firm could be viewed in two ways. You can think of it as the sum of the market values of claims to this firm. What do I mean by claims? It could be equity, it could be debt, right? So basically, you have this accounting identity, right? So you have assets on one side, claims on the other side. So what I'm saying is, if you want to find out what the firm value is, you would just simply add up the values, the market values, the claims to the firm. All right, or alternatively, you could look at the left-hand side of your balance sheet and add up the assets, right? You could say, okay, what are the market values of these assets? Let's add them up. That's the firm value, right? So in essence, you're just basically saying that if I have the market values, then I either can work with some of the values of the assets or some of the values of the claims, and then call that firm valuation. All right. So here we're getting at some important point though, right? When you talk about this split between liabilities and owner's equity, you're basically talking about financial structure of the firm, right? So when we use this equality here, we're in essence assuming that it really doesn't matter whether you do 20% liability versus 80% equity or vice versa. It really doesn't matter, right? What really eventually matters is that the sum of the claims is actually the same as the value of the claims is the same as the value of assets, and that's exactly what we think there is in perfect capital markets. All right, that's really important. The assumption here is that we have perfect capital market, so it really does not matter how we finance the operations of the firm, the investment projects of the firm, whether it's debt or equity. It's really quite irrelevant. All right, but in imperfect capital markets, which we will see later in the semester, capital structure is going to affect the firm value, and the impact that could actually be quite dramatic. It's going to give rise to conflicts between different stakeholders of the firm, and then that's going to affect the firm value by big magnitude. So for now, though, we're going to assume that capital markets are perfect, so it really doesn't matter how we finance the firm um, projects. Uh, you can just rely on that accounting equivalence. All right. So how is the firm value related to investment decisions? Okay, so when you think about the firm value, you're going to say, all right, so when I make an investment decision, I will want that investment decision to add value to my firm, right? Which means that that particular investment decision must have a positive net present value. And how do you calculate the net present value of the firm? You're going to say, okay, I'm going to calculate how much it costs today and what's the present value of future cash flows from that, and then what the net is. If the net is positive, then that investment is going to add value to my firm. And this is only true if the internal rate of um, return for this particular project is greater than the required rate of return on the project, right? So how do you calculate the present value of future cash flows? You're going to use the required rate of return to calculate the present values, right? So that required rate of return should be the opportunity cost of investing in that firm, and we just agreed that that opportunity cost is actually the cost of capital, what we call cost of capital. So investment adds value to the firm only if the cost of capital is greater than internal rate of return on a project. All right. So this is basically the line of logic that we're going to use in order to better understand how things look like here. Okay. So let's talk about the market line for capital budgeting project in the next video.